Welcome back to Trade with Conviction, your shortcut to making sense of the oil market. I'm Felipe Elling Sherman, and today in the pod we have James, June, and Neil. Hey guys, how are you? All good?
Very well, thanks.
It was great seeing you guys last week in London for our go-to-market kickoff. Neil, let's start with you with a bit of geopolitics, news, headlines. I think that is extremely relevant these days and more. So let's start with that.
Yeah, let's go for it. The obvious one, obviously, was Greenland through the week, which had the whole market in a bit of a frenzy, I think it's fair to say. The basis Trump statements yesterday at Davos, I think we all know it seems like the threat of a tariff war between the EU and the US is now eased. It's not off the table because all we know now is that there's a framework of a deal, and we know that there can be all kinds of turnarounds in the story, as has been the case for the last year. It did have some impact on equities of the week. I imagine there'll be a bit of a relief over the next days. Yeah, the story for now is, as far as we know, not over, but basically much more calm than would have been the case yesterday. A couple of more things to note. I did notice that the EU response was definitely a bit more vehement than we are used to. Basically meaning up until now, the EU kind of looked relatively weak when they were negotiating with the US, but it seemed like something turned around this week because there was a very strong threat of tariffs and actual invasion. And I, for one, was kind of impressed by the combined response from the EU in a way. And the last thing to say, if there are tariffs, up till now, energy has been excluded. Not that that means that oil is not impacted, but in the past, energy has generally been excluded, and the EU's dependence on US energy is still pretty high, also in gas. So just to note that. And the last thing on that is one of the more interesting pieces of sort of commentary, geopolitical commentary I've been tracking over the last few weeks is just the pace of European defense deals, right? Another statistic, if you like, that the EU is taking this seriously is just the pace at which defense deals are being done with India, for example, and also within the EU. So if you look at, all defense shares are very good, including Rheinmetall and things like that. But looking at the shares of Saab, for example, they've done all kinds of deals for new naval ships. They've done all kinds of deals for new jets. It's getting very interesting from that perspective. And one to note for you, June, and we can pick this up later. I was making the statements last week that all these new EU deals with India might mean something with respect to their buying of Urals. So I was quite surprised to see the headline that Reliance was buying more Russian crude last night. But maybe that is not all that surprising when you look behind the curtain, so to speak. But we can maybe pick that up in the crude section.
Yep, we'll cover that in a bit. I've always been of the view anyway that India is very price sensitive. So if the price is right, they will still want to buy Russian oil.
Yeah, which
We'll,
makes
we'll cover that. Yeah.
No, Europe is definitely taking this seriously now. They're looking at their alliance in a very different lens. As we talked in the last year, it's the end of the world order. I don't know if you even heard Mark Carney from Canada and Davos, talking about this alliance of the medium-sized countries, and it was a rupture with the old model. And it is a fact. It is a fact. And, you see, for example, Europe now doing a deal with Mercosur. It's a deal that has been on the making for the last 25 years. And suddenly, also on the back of these changes of alliances with the US, it's finally getting signed. And on top of all these, defense contracts that you're mentioning, Japan, India, etc. So it is quite interesting to see how Europe is changing their dynamic and their geopolitical stance based on this rupture of alliances. And same thing with Canada, Australia, etc.
Right. So why don't we talk about Venezuela? Venezuela is the other big geopolitical move that's still in play and concerns oil. I think one of the key questions, particularly for things like the WTI Brent spread, for example, has been how much Venezuelan crude will actually go to the US Gulf Coast relative to normal, because of course they already take a fair bit, most of the Chevron barrels, and how much will be marketed to Asia, because we know that basically it has been marketed to India and the Chinese. There has been a bit of, I guess, an indicator on that. So June, you can maybe pick this up, but I believe Valero are now the first known buyers from Vitol. Is that correct?
Yeah, the headline just came out very recently, and the price that was indicated was Brent minus 850 to 950. This is in comparison to the original offer of discounts of $6 to $750 per barrel. And there were also the headlines initially that the original offer to the Chinese buyers was at minus $5 per barrel. So this is quite a step down from the original offers.
Okay, so it's sort of being marketed more aggressively over, I guess, generally speaking, which kind of makes sense. It's not particularly nice crude. And the other thing from that is it gives a bit more indication on freight, right? So it is it's widely expected to be bullish freight, but it's different if it's going into the Gulf Coast. It's more a story of, let's say, the aftermarket, I suppose, than it is if it's all being marketed into India, which would be more a kind of VLCC story. And the only other thing to say on that is basically it seems like the Indians are waiting to understand better the sanctions regime, because we still don't know really officially if these barrels are sanctioned or not. Isn't that true?
Yeah, there's really no confirmation that the Venezuelan oil is not sanctioned yet. All the rhetorics is there's a license to sell by Trafigura and Vitol. People are all getting ready to buy,
Yeah.
refiners, etc. But there's no official lifting of sanctions, so it's very grey area.
It's almost easier to buy Russian crude than it is to buy Venezuelan at this point in time.
Probably, yeah.
Oh well, that's one that we'll keep track of for the next for the next week or two then. And the only other last point really on geopolitics just now, not that there's a shortage of things to talk about, is Iran, and it seemed like that story now is on the back seat again. The last we heard, there's a US carrier group going into the region, and my read on that is the story's not over yet. I think the conclusion was that Trump wanted to do something fast and marketable in Iran, but he didn't necessarily have the military capability to do that, and it wasn't really the right time to do it, but it's still on the table for the next 2 weeks. But for the moment, it's basically on the back burner.
Yeah, something to monitor in Iran, but it's definitely not the same situation as Venezuela. Venezuela definitely looked like an agreed exit of Maduro with, surprisingly enough, the number two remains in power, and she's fantastic, according to Trump, and everything's going to be great, so it definitely looked like an agreed exit with the backing of the number two and number three. I don't think you can get the same kind of story in Iran, and it's a very different animal. But before we move on into the markets, we keep talking. I want to leave you with a little thought on geopolitics and the friction we're seeing. It often looks like chaos, tariffs on allies, talking about buying Greenland, which was something unheard of before, constant tension between the West. It's this illusion that we knew on the West, we knew the theoretical enemies, who they were. And suddenly now it's like, well, who are our enemies or who are our allies, and can we trust them and all that? But I don't know if you guys heard of a guy called John Mearsheimer. He's actually a political scientist. And he has this theory called offensive realism. And the theory is quite simple, and it assumes that the world is anarchic. It doesn't mean that it's chaotic. It just means that there's no world government. There's no supreme power. There's no 911 you can call if you get invaded. So basically, it means that you're on your own. That's the first principle. The second is that the world is uncertain. You cannot really truly know what another country is planning to do. You might be friendly today, but you don't have any guarantees that that ally will not be aggressive in 10 years. And we're now starting to see that, for example. And then the third principle is survival. Because of that uncertainty, the only way to be 100% safe is to be the most powerful nation in your region. Now, the concept is that you cannot control the world, but you can control your region. And that, you want to dominate your backyard completely while simultaneously preventing your challenger. In this case, US wants to control the Western Hemisphere, and at the same time, avoid or prevent your challenger, in this case, China, to control their backyard, and hence the relationships with Japan, with Taiwan, etc. Now, if you apply that logic to what we're seeing right now, Greenland isn't really a joke. He's not, he's for real when he talks about taking control, whether it's an annexation, a purchase, or military action. They want to have that security on the Arctic. And it is something that is very important for them. when you think about Venezuela, it has, in a way, it has nothing to do with the oil. It just has to do with the fact that they don't want anyone in their backyard or any rival power setting shop in the Western Hemisphere. And when it comes to Europe, and the relationships with allies, when I say Europe, it's actually Canada, Australia, and to a certain extent Japan. It's, the argument here is that it's a temporary alliance, it's a temporary wedding or marriage, and it's just a convenience. And if the US and Europe are no longer share the same primary threat, that marriage falls apart. And we're starting to see where Europe is not distancing completely itself from China, and on the contrary, now it's getting closer to it. So the takeaway here is that what we're seeing here is not necessarily a random disruption. We're seeing the return of great power competition. It's a bit the end, or at least that's what Trump wants to do, is the end of this NATO, or maybe not the end of the institution, but the way it was run, NATO, UN, the rule of law, and it just becomes the rule of the most powerful, and we're seeing that regionally as well in other regions. So think about this when you're looking at all the noise and the announcements and all that, particularly when you're looking at long-term charts and the market. So it's this realism that is now becoming evident, and we're no longer looking at efficiencies and prosperity, but much more around security. And that is the number one aspect that people are looking. But anyway, I just want to share that thought. I thought, I was reading about this guy and I thought it was quite interesting to look at the world in his lens, the realism. But again, we're not here to only talk about politics. But again, if you don't talk about geopolitics in today's market, you actually look a bit like a fool. So let's move on to crude and flat price in general. Neil.
Yeah, just one way to segue between the two, though, is obviously what you just said is, the result of that is why oil is trading the way it is just now. Like, you note that we haven't had any contango except very brief sort of 3 cents contango in Dubai over the last few months. Brent has always been backward at the prompt. And the reason for that is geopolitics, right? It's mostly that. I just wanted to note that if you look at like the IEA balances, they've been like 2, 3, 4 million barrels per day long for months already, right? And we see some of it emerging in the US. Like, you can look at the total US stocks, they're building quite strongly, more strongly than normal over the last 2 months. So why are we not contango? It's basically, it's partly just the risk of the headlines. Anyway.
No, I agree. I mean, and you think about this on a security, you just said yourself, it's easier to buy Russian crude today, that uncertainty. But the reality is that you're now getting to a point where you have the Russian crude on one side, the Venezuela, and all of that fungible global market is, I wouldn't say it's over, but it's definitely under threat. And it's difficult to make long-term predictions within that environment, for sure.
Yeah. And then very recently, though, what I just said is probably not true. And the main outage that we've seen, of course, there's been a bit of slowdown in Venezuelan loadings. But the main outage we have seen is from CPC, and that's been going on for quite a while. And it's been getting worse. And the shortfall at CPC might be reaching something like 1 million barrels per day by now. Temporarily, of course. There's been a force majeure at Tengiz, where there was pipeline issues. Of course, the whole problem at CPC has been a result of aggression, tanker attacks in the Black Sea. So again, it's geopolitics, right? And the story at CPC is that they load from 3 SPMs, these floating moorings, and one had been in maintenance. Another one was attacked, leaving only one to operate. Weather has basically prevented a second one from coming back from normal maintenance. So now we've got this actually quite big outage, and that explains also what's been happening in Brent spread partly, but it does look like it's temporary. So I think I saw some headlines this morning that they will be getting one SPM back into operation relatively soon. So, but the point is, when you get a few of these large outages mounting, then the whole narrative can change, right? Even 3 million barrels per day isn't impossible to destroy once you have a number of these things mounting up, which looks like it sort of started to do over the last couple of weeks.
You want to move on to Jody?
Yeah, let's do a very quick roundup of Jody before we get June on for crude. We got the October data. The only thing I really noticed, and of course I just do it very generally, one for you, James, as well, In Europe and Asia, there is a bit of a flip to a bit more crude in storage. So it moved from quite down year on year to 10 million barrels a day up year on year in those two big regions, which is not nothing. And on the other side, product stocks are still tight. And it's true for middle distillates, it's kind of true for light distillates, and demand hasn't fallen through a floor. So it's again back to this story we've been talking about the last few months. We're not quite sure what has changed about the refining system. There's not loads of additions.
No.
Demand hasn't dropped off. So is it fair that we have margins that are sort of tentatively not great for medium setups for certain crudes? Or are margins now too low? And that's basically a theme we want to tackle today and also in the next couple of weeks. And the last point in that is also just about crude slates, and that's something that we also want to talk about between crude and products. The crude slate is going to get heavier. Venezuelan barrels coming to the market is one thing, but generally speaking, there's way more sour crude in the market than there was this time last year partly because of OPEC. And typically what happens is you get more middle distillate and you get light distillate, less light distillate. So that's another thing that we want to think about also for the, let's say, Q1 and Q2 outlook for all products, really.
Okay. Moving on, I mean, you want to continue with the physical crude markets, or you want to make a pause here, Neil?
June can do crude.
Okay. So June, let's move on to the physical crude markets. Let's do a physical roundup, if that's okay with you.
Yep, let's talk about India's crude buying. It's a very fluid situation. First of all, it does look like most Indian refineries are backing away from Russian barrels and buying more into the spot and term market. We initially had the reports of higher Saudi term 2026 allocations into India and, of course, into China. BPCL has issued tenders seeking long-term purchases of Murban, Oman, and Basra. Reliance as well has moved away from buying Russian oil, although they had the 500 kbd of Rosneft term. But what we heard in the latest report is that they have actually placed orders for non-sanctioned Russian crude for delivery in Feb and March. MRPL has also been seen buying more AG crudes. Where we are now in terms of the buying import pattern, January imports is set for 1.1 million barrels per day, roughly, down from about 1.9 to 2 million barrels in November. But that could be lower, and Feb imports will be interesting to watch. So aside from buying from the AG market, Indians have likely now the option to buy Vents or other heavy crudes backed out from the US Gulf Coast, just say more TMX crude or WCS, and blend this heavy stuff with lighter crudes. In order to do this blending operation in the crude side, you will need sizable tankage capacity and as well as good blending facilities, good pumps, good piping situation to enable this fairly risky operation. But the Indians are known to have this capability. So my view is if anyone can do blending operations, the Indians can. And therefore, are we going to see a structural reduction in Russian crude purchases from India? The answer is yes, lower than before, but to zero, doubt it, because at some point the prices will likely be low enough again for them to step up, and we already start to see now Reliance coming back to buy a little bit here and there. So yeah, unless there's something binding in the deals, the arms deal that we talk about geopolitically, that they will not be able to get access to those arms from US if they buy Russian oil. But otherwise, if they're within the boundaries, then I think Indians will still want to buy again after the price comes off further.
Thanks, June. What do you think that means for the AG spot market?
It's quite interesting to see Murban is getting a premium uplift. There's two reasons for the Murban story where it is right now. One is the impact of shorter supply of lighter crude like the CPC, and also the expensive WTI coming into the Far East. So that gives a boost to Murban itself. And secondly, it is actually a good light blending component for all the heavier grades. So even at March Dubai plus 220 levels, and yesterday was 240, due to the wide Brent Dubai EFS spread and dated being very strong, the Murban ARB is actually even open to Northwest Europe right now, which has only happened 2% of the time in our signals dashboard in the last 12 months. So there's two possibilities here. Number one, the Brent Dubai has to fall off from the current 150 levels to stop this unnatural up from happening. Or number two, the Melbourne FOB actually is supportive and can still even go up from these levels.
Wow. Okay. I was not aware of that. It's extremely rare to see a situation
Yes.
like that. It's
I've got many traders talking to me about this right now. How far can this Melbourne FOB go up? Yeah,
Yeah.
it is really supportive.
It is definitely an anomaly there. Yeah. And do you have anything to share on the refining margins and the impact of what you're saying here?
Okay, let's look at Northwest Europe. 40s cracking margin is closing in on the zero line. Johannes Sverdrup,
Okay.
which is a heavier crude, cracking remains fairly healthy. In the Far East, Melbourne cracking has taken a hit relative to spot and term AG medium sours, but at least Melbourne's cracking margin still is remaining positive, $2 to $3 per barrel, whereas the competing long-haul light sweets into the region are now firmly negative, except for WTI cracking, which is borderline. We have also upcoming turnaround seasons in Europe and the US, which are rumored to be quite large. Therefore, the light sweet crude demand can fall very fast as some of this supply returns next month. So it's more likely that Brent has to weaken to bring the light sweet crudes up back into the Far East.
So let's continue on the North Sea situation with Brent. So what is the latest on that?
So the North Sea has been hugely beat up by news of outages of CPC, plus also Libyan outages due to the weather at the load ports. Forties is at the 18-month high premium. And now we are seeing extreme valuations where WTI FRAs and the spot and term AG light sweets are valued at very cheap levels into Northwest Europe, as what I shared earlier on the Melbourne arbing into even Northwest Europe.
Yeah.
TD7 freight RBI now also materially undervalued at about -$6 per ton. And the disconnect has widened sharply over the past week, suggesting that this Aframax freight is still too cheap versus the underlying crude economics and broader freight complex. So we do feel like the light sweet situation has to fall off from its peak in North Sea. Yeah.
Just before we move on to this, maybe RBI is something we coined internally. Maybe you want to explain what that is for people that don't know?
So RBI stands for Relative Basket Index, which is Sparta's freight methodology to understand whether the particular freight route is currently undervalued or overvalued based on the ARB picture that we are seeing. So given that the RBI for TD7 is undervalued, we suggest there's plenty more upside to this freight number.
Okay, thanks for that. Yeah, and very interesting. James, let's move on to distillates now. It's the first time you're on the pod this year, so quite a belated Happy New Year to you. But more importantly, how have things panned out over this period?
Yeah, well, I'm a little bit embarrassed. It's been 3 weeks I've not been on the pod since last year, so I've kind of missed the changes that we've had about geopolitical events at the start of the podcast. I really enjoyed that. And that kind of lets me segue into, we're going to be holding a live recording of the podcast just before our IEA Week event in February.
Yeah.
So please register your interest if you'd like to join. But back to distillates. So last time I was on the podcast in mid-December, we were predicting a very bullish start for 2026 for diesel and jet. And though it took quite a long time, it has started to finally manifest. Although over that time, the end of last year, the beginning of this year, we saw quite some supply strength. We had quite a good run. And in fact, these stellar runs contributed to the fact that Jan-Feb ice gas oil expired just above contango at plus $1 per metric ton. It even danced in contango for periods of the last week before expiry.
So what have been the positive changes? Elucidate some of the events for us, if you don't mind.
Well, we've seen big moves in the HOGO. We've seen big moves in the East-West. As well, this has kind of been followed or actually triggered by big moves in gas oil cracks. And actually over the last 2 or 3 days, big moves in heating oil cracks and spreads, as well as ice gas oil cracks and spreads as well. The HOGO, I think Neil and Phil were discussing on the last podcast, they were guessing and predicting that it had upside potential there on the back of impending cold weather and the continuing low diesel stock picture in PAD 1 and 2. And since then, the weather has gotten really cold and pretty widespread, pretty much the whole of the Northern Hemisphere. Even where I'm in the Netherlands now, we can really feel it. Now, this strength in the HOGO has really closed off the US Gulf MR transatlantic arb into Europe. And you would presume that actually this has probably triggered as well a strong distillate flow up the Colonial Pipeline into New York Harbor as well. That tends to be a seasonal one, but you probably think they would be maxing currently as well. Now, cracks as well, as we've kind of already spoken about, have really responded to this increased demand as well. And as well, like my colleagues Phil and Neil were speaking about in the last podcast, that there was a lot of dry powder to the upside for distillate pricing generally. As supply was really on a strong run, but now the supply risks are to the downside too as well. So that's all the kind of predictions they kind of made and what we had at the end of last year really played out.
So how has that shaken out in the ARBs and perhaps more as a consequence of your trade calls?
Yeah, so Middle Eastern diesel and jet ARBs actually, these firmly point west, even if you consider Cape routing now, due to that real widening of the east-west that we've seen over the last period of time. We should see increased flows on that route for Feb, early March arrival. And that's what kind of also assuming that we kind of don't continue to see an increase on Suez routing. We've seen Maersk and others flirting, doing more and more of this route over the last period of time. As we've kind of discussed, the US Gulf MR arb into Europe for diesel is closed as well. And despite the strength in Singapore regrade, some Middle Eastern jet arbs are open into Europe. So maybe kind of holding back any kind of real strong increases in EU jet pricing. But because of this Singapore regrade strength, most of the jet arbs into Europe are closed currently. So how does that kind of translate into some of my trade views from here? So the East-West we kind of spoke about has really ballooned out to record seasonal levels currently. That seems mostly due to like a kind of short-term surprise, demand surprise, weather-driven as well. Is that sustainable? It's kind of been propelled by the strength in cracks. Ice gas oil spreads have kind of contributed to this move as well. So maybe there's a buy on the East-West. I think there's continuing reason to be long ice gas oil spreads and heating oil spreads into the short to medium term. Now let's think about that. I was kind of really interested in what June was saying about real weakness in margins. That comes at a time when we're also going into maintenance periods in the US Gulf as well as Northwest Europe. East Asia comes a little bit later. So low refining margins going into maintenance should continue to add strength to ice gas oil spreads and heating oil spreads from here as well. Now, it's interesting. We've seen a real ballooning of the HOGO. But I guess I'm more bullish gas oil than I am heating oil. So maybe it's an interesting trade to think about maybe in the more medium term going short the HOGO as well. And with this continuing strength in Singapore regrade, which should only get stronger now as we kind of go further into East Asian heating season as well. That closing off ARBs into Europe as well probably means that I'm still bullish EU jet pricing from here as well.
Thanks, James. So let's have a quick fire round on the other products. So starting with gasoline, you want me to go for it, or someone had it in mind?
I was just going to read it. It doesn't matter. You
want to go?
Yeah. Yes, I'll do the light distillates very quickly. The week did start off on a bit of a more positive note, just following last week's trading. What happened last week was we actually saw EBOB spreads trading at some of the deepest seasonal contangos we've seen in a while. We actually got -6 Feb March. The soundings from the team and also from the market seem to suggest this is more of a story about bidding up down the curve than it is a problem with immediate supply. Things like a relatively tight spring, lots of turnarounds, possibly some yield shifts. And yeah, we can kind of confirm that by the fact that the components market isn't all that weak. So that's the thinking there. And the other thing is that there is a rumored extension to the Dangote RFCC. That doesn't necessarily surprise anybody, but it is one of these kind of binary things for the gasoline market. Basically, the consensus is that the thing will come back, and then when we get news that it won't come back, it tends to be a relatively bullish signal for the spring. What it did do was it opened up ARA's competitive advantages against the Gulf Coast briefly, and it also narrowed the prompt E10 blend margins, actually to the extent that they closed off for the first time this year. And in the East, it's relatively similar a bit. There's a bit more supply. It's pushing pricing to storage, and the blend margins are almost workable in Singapore thanks to a downtick in component diffs.
What about NAFTA? What are you seeing there?
In NAFTA, the main thing is, last week we talked a bit about the gas nap trade being relatively long going into the spring in gas nap, and we've talked a bit about yield shifts and stuff like that, but the main thing that we see this week It's just the weakening in physical premiums in Japan recently. So it's kind of divergent from the paper market. It seemed like the physical Eastern market is now weakening quite a lot. And that is basically a warning signal for us that actually something will begin to happen on paper NAFTA soon as well.
Is that it?
That's it.
Okay. Yeah. Sorry. Okay. Well, thanks a lot, guys. I think that's a wrap for today's market.
Thank you too.
Before we say goodbye, just we're hosting our first live podcast. So during IE Week, if you guys are in London for IE Week and you would love to get to know face to face James, June, Neil, please don't hesitate to join us. Details will be shared in the link, but we're looking forward to see as many of you. And yeah, so thanks guys for today and looking forward to seeing you next week.
Thanks very much.
Thank you.
Thank you.